No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrot, your host. How many of you out there think that you pay too little in taxes? Most of us think that it's the opposite, right? That we pay too much in taxes. And of course, we also know that the Tax Cuts and Jobs Act that reduced taxes for a time is approaching the time when that's there's a sunset provision basically, and our tax rates are automatically going to go up. The last year of the tax cuts that we currently have under the Tax Cuts and Jobs Act expire in 2025, meaning in 2026, those rates are going to go up. So we're going to see, for instance, right now we have the 12% tax bracket will go up to 15%. The 22% bracket will go up to 25%, 24 to 28, and so on up the line. This is something to be mindful of when it comes to planning. Knowing that we basically have a window, if we count this year, we basically have 4 years in which we could do some things. For instance, Roth conversion strategies, this would be a good time to look at that. In particular, if we can do those conversions at that 12% rate. Now, of course, depending on your situation, even at the 22% rate, there's some advantages to be had depending on what your income tax bracket is going to be when you retire. So one of the things, or if you're already retired, these are some things that we look at, of course, as well. So last week I had Dr. Friday on, and we were working off of a product from Nationwide Retirement Institute called Managing the Taxes on Your Retirement Income. And I'm gonna kind of go back, recap a little bit of that, and then finish out what we weren't able to get to last week. Now, one of the things that I want to share with you in this is, again, about managing the taxes on your retirement income, how to develop a tax-efficient retirement portfolio, and also how to set up a tax-efficient retirement income plan in retirement. One of the things that we get into is it's not just what, we talk all the time. In fact, it's not just what you make, it's what you keep. And if you want to keep more of your hard-earned money, one way to do that is to understand how the tax code works and make sure that you're not paying more in tax than you're legally required to pay, which unfortunately a lot of people are. It's kind of ironic when they talk about the tax cheats, if you will, those that are not paying their taxes or not paying the fair tax or, reporting everything or whatever it might be that they're concerned about. And they've got numbers out there of how many billions of dollars this might represent. Now, what I see is, when are they going to put out a program about, I think there's an offset, basically. I think there are a lot of people that pay in a lot more in tax than they're legally required to pay simply because they don't know the rules or they don't use certain strategies that could help them reduce their taxes over their lifetime. So the thought of 87,000 more IRS agents out there doing audits, doubling basically the IRS workforce, that's a little crazy to me. And it's a little scary in terms of how we see things today. I'm not a big believer in big government. I think that the bigger government is, the more powerful government is, less helpful that is for us, and the more it is for government, for those in power, basically, to forward their own agendas. And that's not always in our best interest. So one of the things that we look at is we can't change those things, right? I can't control. I can, do my part as a good citizen. I can, vote. I can, do the things, conversations with friends and such. But in reality, I have very little control there. Most of us don't, right? So what we do have control over is how we can manage our own finances to help us in situations that we can't control. So if taxes are going to go up, well, we know taxes are going to go up, and we probably expect they'll go up even more than just the sunset that's going to happen starting in, taxes going up in 2026. So we know that's coming, but we also see the amount of spending and debt that's racked up, and we got to be thinking, how's that going to get paid, right? At some point, they're going to be raising taxes even more than just what this sunset's going to do. And then how do you position yourself knowing that? all right, or if you believe that, as I do, then how do we position our finances to help reduce those taxes? Well, it starts with understanding some tax basics. So we're going to get into the program where I'm going to recap real quickly, starting with the types of taxes on income. So there are two kinds, if you will, of taxes on income. One of them, ordinary income tax rates. These are your highest tax rates. This is where I was just talking rather about brackets. 12% bracket will go up to 15, the 22 going up to 25, and so on. Well, those brackets, like I said, that's going to be your highest tax. So, for instance, with ordinary income tax, this is what applies to wages from employment, certain retirement accounts, in other words, withdrawals from those retirement accounts, bank account interest, savings, money markets, CDs, Social Security. Part of your Social Security, for many of you, are paying taxes on that. Capital gains taxes, this is more about investments when you sell stock mutual funds, that type of thing. Most kinds of bonds, profit from selling real estate. We're going to get into that. But basically, your capital gains rates are always going to be lower than what your ordinary income tax rates are going to be for that comparable amount, and we'll talk about that a little bit more. The next I want to share with you on the next slide, and I'm going to kind of crank through these because we went through it last week, so I'm going to move through them quickly to get to where we left off so I can finish out the rest of the tips for you. Now, the ordinary income tax bracket, this is showing you those brackets, right? It's showing you 10%. So the way the progressive nature of our system works is you have a standard deduction, right? Now, deduction means that's money you're not going to have to pay tax on. So, for instance, if you look at a couple, age 65, married couple, married filing jointly, that is, you're looking at a standard deduction. It starts at $25,100, and then you add in $2,800 for being over 65. And that brings it up to about $27,900, almost $28,000. That means that first $27,900 you don't have to pay any tax on. Okay, so zero tax on that. Then the next $10,000 is shown here on the. Next $20,550 for married filing jointly. There you're going to pay 10% tax on that, so it'd be $2,000. So basically, if you look at that, you got almost $50,000 in income, and you've got $2,000 tax on it for a married couple, age 65, filing jointly. All right. Then the next $63,000 is going to be taxed at 12%. So basically, what it shows us is that we're going to have approximately a little over $9,000 tax on $108,000 in income. So about an effective tax rate of 9% there. Now, on the next slide, it gives you an example of how taxes are calculated. And there you see the different tax brackets. And in this example, it's looking at someone who's has a total annual income of $150,000. This is a single in this example. And basically, it shows that on that $150,000, even though some of their income is going to be taxed in the 24% tax bracket, the actual effective tax rate is 17.5%. And again, that's the progressive nature of the system. So the first, for a single person, age 65, the standard deduction, $14,700, which means you pay zero tax on that amount. Then 10% on the next $10,000, 12% on the next $30,000, and so on up the brackets. Okay? Now, we're going to go to this, the next slide, 3 categories of retirement income. So when it comes to the brackets, just, again, it's just showing you the difference between tax brackets. Your brackets are typically going to be higher than your effective tax rate because you're not taxed at the same. If you go into a higher bracket, it doesn't mean everything gets taxed at the higher bracket. You're still only getting, like I said, zero on the standard deduction part. So the first, in that example, the first 14.7, zero tax, and then so on up, 10% on the next 10. 12% on the next 30, and so on up the brackets. That's important to understand how that works, and there's some other things that go with it, and that goes with those brackets. When we're talking about the 10 and 12% brackets when it comes to capital gains tax, as I'll show you in a little bit, what you're going to see there is the capital gains tax rate is well, first off, if you're in a 12% bracket, so again, we'll use my example, married couple, age 65, right? Both of them 65 or more. For them, if they're in that 12% bracket, which basically would be about $108,000 in income, and including the capital gain that they may have, it still keeps them under that $108,000, then they'll pay a zero tax. Okay, only if they exceed that would the tax go up. Now, there's some important tips that go with that, and I'm going to get into those right after this break. Join me here. I'll be right back on the Retirement Report.